Hi everyone, this is Jason Bierek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He was one of the youngest stockbrokers in Canadian history. He's author of some of the best-selling stock market ebooks on Amazon, including Bear Market Rising, Profit from the Bursting of the Cheap Money Bubble, Collapse, How the Federal Reserve Created Another Stock Market Bubble and Why It Will Collapse, and The Great Supercycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. He also has the Addicted to Profits newsletter, and I think in the past he was a hedge fund manager. Dave Skarica, thank you for joining me again.
Thanks for having me.
Now, Dave, I know you are a good global macro thinker. We've had really good discussions in the past. So what are your views on what the central banks have been doing the last couple of years? Because, you know, the Fed hasn't done QE since, at least stated publicly, since 2014 that ended. But these other central banks, the Bank of Japan and the ECB, have gone crazy the last couple of years. So what are your thoughts on the global macro picture?
Well, I think in 2015-16, that was a really key kind of time frame for the markets. If you go look at what happened then, it was actually, I turned very bearish in 2015. And there was a correction, you know, in 2015, 2016. The markets went down about 13, 14%. Many stocks went down much more than that. I remember I was short Sotheby's at the time, and Sotheby's actually went down like 60% at the time. So, like, you know, you saw this kind of unwinding. The yuan was weakening. And I think that in 2016, then the Fed put off all their interest rate hikes, right? And then you had European Union and Japanese central banks essentially coming to the rescue of the Fed. And that kind of pumped, you know, this part two of this bubble where, you know, the market bottomed and then went higher. And I think one thing that has kept these liquidity injections happening was actually all the political uncertainty. You know, you had Brexit was the first, and then you had Trump getting elected. You had a populist party in Italy getting elected. And all of these kind of rejections of the establishment means that the central banks have to keep, you know, like pumping liquidity into the system. And then the offshoot of that liquidity into the system, even though, like you said, the Fed hadn't, you know, been printing money since 2014, is you have all this financial engineering going on. Companies can borrow very cheaply and then use that to buy back stock and then hit their earnings per share numbers and, you know, also inflate the price of their stock and then, you know, make money on their stock options, make money on cash options that are directly, say, related to meeting the EPS numbers. So this is like all the offshoot of all this cheap money, and all has to do with like being able to borrow over zero. Now, then there's this other side of the boom as well, where you get this big boom in emerging market debt, and a lot of the emerging market debt is issued in U.S. dollars. And the philosophy behind this is very simple. It's like, well, I'll loan to this Brazilian company or Turkish company or Argentinian company or whatever it may be at 5% in US dollars because, and we're only talking about 1 or 2 year bonds here, not like long-term bonds, because I'm getting 0% in a treasury, right? Like a short-term treasury, like a 1 year, right? So the problem now is with the treasury yield back up to 2% and maybe going to 3%, well, 5% doesn't look as good on a US dominated bond out of Turkey or Brazil. So then capital starts leaving, and then, you know, and then those currencies start collapsing, and those the companies in those countries can't repay the capital on that bond, and I think you're gonna have this effect where at some point, what's going on in Brazil, Argentina, Turkey, that is going to filter over into the major markets, and you know we're seeing a spike starting in Italian bond yields. So I think at some point this will affect the major stock market. The problem with all this stuff is timing, right? This has become the longest bull market ever because all this liquidity pumped into the system. So the question is, when does it actually burst? And by the way, the 1920s are always viewed as like this huge boom and everyone was doing great. But if you go look at, that was in the United States. If you go look at the UK had high unemployment in the 1920s after World War I. Germany obviously had hyperinflation. Russia turned to communism. So what happened was the stock market bubble kind of covered up the fact the world was getting like basically you know like shakier, and the geopolitical situation was deteriorating. So I think that's what's going on now too. You've got this huge boom in these equity markets, but it's hiding the fact that you're seeing all these tensions, and probably once you get this big bear market finally occurs in the equity markets, you're going to see the geopolitical tensions really blow up, and like it's going to make Trump look like, you know, like a saint when that happens.
That's a good analogy there with the 1920s, because, you know, it's called the Roaring '20s, the Booming '20s, but the main boom, like you said, was in the U.S. There was innovation in manufacturing there. There was innovation with radios and automobiles and refrigerators and those types of things back then. That's what was driving the growth. But the other part is, you know, you talked about the depression and unemployment in the other countries. There was tons of flight capital from Europe and other places coming into the U.S.'s markets back then. There was a huge property bubble in Florida, too. There was a huge building boom in Florida back in the 20s before the 1929 crash. So I think we're seeing that to a certain extent. History doesn't exactly repeat, but it does rhyme. And we're seeing that to a certain extent now. Because I mentioned that on previous podcasts, Dave, that, you know, what is happening now with the capital coming into the U.S. and stocks, bonds, and real estate, that does remind me of the last couple years in the U.S. prior to the 1929 crash.
I do think there's like a secular thing going on too, where the problem in the West that we have, especially I think in the English-speaking countries, is that we could all go into conspiracy theories and all the problems we have and the fact that, you know, freedom has declined, but essentially we do have these economies that have like a rule of law, you know, you have property rights. So the problem you're getting is we can, like I was just I live in the Bahamas, and I was back in Canada for 2 months, and to be honest with you, I couldn't stand it after the end of that 2 months because there's overpopulation. I'm from Southern Ontario. There's a housing bubble.
The culture of Toronto area, the greater Toronto area, changed a lot too, right?
Look, I got it. Like I'm trying to be politically correct here, but yeah, there was.
Okay, we'll stop then.
Look, there wasn't a lot of integration, I thought, going on with the current immigration stance in Canada. And then there's also the suppression where if you say anything, you're a racist, right? So the suppression of free speech, all these things. But the problem is,
or even a Nazi now, yes, unfortunately.
Yeah, exactly. And it's like, but the thing is, let's face it, if you live in sub-Saharan Africa or you live in, in Myanmar, it's still a lot worse, right? So you're still getting this influx where, like, that's as we don't like. I'm maybe sound old and crusty, but I don't think where I grew up is, what it is now, what it was then. But, it's still a lot better than most places in the world. So you're seeing this influx of capital and people and et cetera. But, at some point, it just has got to end. It's causing, too, these huge dislocations. And it doesn't matter if the money's coming from the Middle East or China, et cetera. You're basically seeing gentrification. And the average person, working class person, cannot afford a home in the Toronto area anymore. The average price in Metro Toronto is like 1.6 million, and even in the suburbs, you're talking half of that, 900,000. How can the average kid coming out of college afford $800,000 home? I'm not talking about a nice home. I'm talking like almost like semi.
They're lucky to have a shitty job, let alone being able to buy a home, right? So
you're making $60,000 a year. How can you afford this? It's just like, so you're seeing that. And by the way, I think that plays into all the socio dynamic where you've got mass shootings or this and that. It's not just like whatever guns, or it's not even like, blaming it on, radical Islamics. It's like, it really is like people.
So you're saying it's an offshoot of a bad economy. So people are doing crazy, irrational things to try to survive and, make money and stuff. So they're resulting to crime. Is that what you're saying?
Yeah. It's just like you have too much traffic on the road. You have too much stress in your life. Your rent is too high. Your housing prices are too high. You can't afford that. So then you kind of just crack. And, if you ever seen the movie Falling Down, Michael Douglas, that's an older movie. It's kind of like that kind of scenario, So, but anyhow, so all these things are going on. And then you have this kind of fakeness about the economy where, like, oh, the GDP is going up, the stock market's going up due to a lot of this cheap money. And people are kind of told things are good. But, all you got to do is look at the participation rate, especially in the United States, is that you're at 40-year lows. And by the way, the collapse in the participation rate is happening to people under 30, right? People over 60, it's like an all-time high. So this myth they're trying to sell you that, oh, the baby boomers are all retiring, that's why the participation rate, actually, that's not going on. Older people are working longer because they can't afford to retire, and younger people are dropping out because they can't get a half-decent job. So all of these things are going on at the same time. But the question is, and what we do for a living, when is this going to actually affect the markets? Now, will the emerging market crisis, like I just noted, as they keep raising interest rates, it makes all that debt that was issued to those countries in the emerging markets, it makes it less and less appealing, to foreign investors. People will pull out. Those markets aren't as liquid. So will that spill over into the West? I don't know. Spanish and French banks own a lot of debt in Turkish companies. So will that kind of start the next crisis? I don't know. But I can tell you that I think what we're going to see is the Fed will keep raising rates until the market finally cracks. And remember, this year we have a one-time gain for corporate profits and stock buybacks and all this stuff because of the corporate tax cut. But next year, those tax cuts become more normalized, and you're not going to see that huge inflow of cash coming into corporations anymore because year over year it won't be there anymore. So once you get that kind of one-time gain ending, the question is, will you continue to move higher, et cetera, et cetera? We had a good GDP print in the States in the second quarter. The third quarter is looking at like 4 to 5%. So when did this kind of end? And then, and also you have fiscal stimulus. They're blowing up the deficit right now. I'm a libertarian, so I believe in the lower taxes, but they're not cutting spending to correspond with it. So, but that is a short-term stimulus to the economy because the government's spending money, consumers are spending money, money is flowing into the economy, and that helps the stock market. So, but at some point, the market is going to revolt against $1 trillion deficits at the top of an economic cycle.
I think you did a good summary there. If I could add some points really quick. So we're recording this on Friday, August 31st, 2018. Our listeners want the date that we recorded this. The dollar index is at 95.10. So the dollar index has had a strong rally since March. Couple points there on Canada. So Canada has credit card debt problems because of the housing bubble here. I think people have gotten greedy with home equity loans and second mortgages, and more affluent Canadians have probably tried to speculate and buy second or third homes. So there is Canada, things have not collapsed yet, but like Australia, there's a lot of tinder there for a housing bubble burst for Australia, and then the two major cities in Canada, Toronto and Vancouver.
Yeah, and I think in Canada too is you have a lot of complacency there because the banks in Canada historically have been pretty conservative. I don't think a bank in Canada has failed in like 150 years or something, right? So like a major. So you do have this complacency, but I think now with the laxing, like for example, most of everyone I know in Canada, they don't have a mortgage. They have line of credits on their home, which is all short-term orientated. If rates go up, they're hinged to that, and and then a lot of the property bubble is actually influenced by the governments because like if your property goes up from 200,000 to 500,000, well, you're paying more property tax on that, and that's more revenue for the government, right? So they don't really care if the average person can't even afford those property taxes, or the rent is too high, or the mortgage payments are too high, because they're getting more money themselves. And I by the way, I've never seen so many roads being constructed in Canada, and I was just like, you know what? These governments have probably just got a huge cash injection because of the increase in property prices. I took one shot. And I can send it to you, and you could put it below this podcast if you want. I took one shot outside of Toronto, and there was like 6 cranes in one shot. And I think actually Toronto right now has the most cranes of any city in North America. And if anybody knows anything about property bubbles or speculation, that's usually kind of the end. So I think in Canada you've kind of got this like when you travel around the world. I'm Canadian and have a British passport as well. You have this thing where people think Americans are arrogant or whatever. But Canadians have kind of a smugness about them where they don't think these bad things can happen in their economy because it really hasn't happened. Even in the financial crisis, okay, the GDP shrunk, the natural resource industry was hit by lower prices, but because the banks, for the most part, have been well run for most of the last 100 years, nothing's really happened on that front. But I think that is going to change. And another thing about Canada, there's companies like Home Capital Group and Equitable, these kind of companies that are doing subprime loans and doing kind of, I would say, very semi-fraudulent things on their loans. And I've never seen that before in Canada. So I think you're getting that aspect of the frothy bubble kind of as well. I don't want to focus too much in Canada because, that's just a smaller economy, but I just think that's kind of like an epicenter of where the bubble's going on. And by the way, in the U.S., you got property prices in places like Southern California, Florida, that I never thought would get close to the 2006 highs, which are back there. And places like Texas and Colorado and kind of the center of the country, those places actually are way above the 2006 highs.
And there's a lot of Chinese money that's all these places, whether it's Australia, the two main cities in Canada, and a lot of different places in the U.S. China's been fueling a lot of this global real estate bubble. There's been a ton. We were discussing this before we started recording. There's a ton of Chinese money that has left China, mainland China, from their credit bubble, and it's gone into real estate all over the globe. So,
and by the way, just to talk about that rule of law factor, what's disturbing about that is, my dad is a judge, and so he actually just gave a sentence for like the biggest white collar crime, like the longest sentence for a white collar crime Canadian history. It was like a Ponzi scheme. So I'm really into that sort of thing. And what's really negligent, what's going on in Canada, is a lot of that Chinese money is money laundering. And they are totally turning a blind eye to that because what I just said, because property prices go up, more property taxes coming in, more money for the government. So they're basically turning a blind eye to the illegal money coming in just so they can have more money for themselves. And by the way, as I'm not going to get too much in politics, as I know a lot of Americans don't like Trump, I personally think the current prime minister in Canada is like way worse because forget it, left, right, he's basically a trust fund baby who's a pretty boy. And he's totally incompetent. So, like, that's another problem, too. If you were to get a downturn in the next year or two, you've got this guy who's completely clueless running the country as well. But anyhow, to where this goes on macro markets is, in the short term, as long as the Fed keeps raising rates, it hurts these emerging markets. I think it's a deflationary trade. I think you've seen copper come down, seen gold come down. That will kind of continue. There's a big short position on all these things. But until there's a reason to cover your shorts, e.g. the Fed stops raising rates and maybe even cuts rates if there's a downturn, those trades will maybe continue. And, we're entering this period of late August into the fall. That's when markets crashed in 29.87. I'm not calling for a crash by any means, but I'm saying that's kind of the seasonality of it. So the question is, do these kind of policies of the Fed raising interest rates, tightening policy, that's sucking money out of emerging markets, deflationary trade, lead to kind of some kind of disruption finally into the equity markets? Does it happen this year? Does it happen next year? I don't know.
Yeah, the timing of this is extremely tricky, and a lot of very smart people on Wall Street, hedge fund managers, have lost a lot of money trying to time this. Also trying to time a devaluation in China. A lot of Kyle Bass and others have gotten that wrong. But, you brought up an interesting point because the human beings, the big money Wall Street guys, they're on vacation. So they're not, it's trading computers now. The really big money human being guys on Wall Street, they're either in the south of France or in Europe or in the Caribbean or in the Hamptons, and they'll be back after Labor Day. So there could be fireworks then, although I think, we're going to have to see the Federal Reserve quantitative tightening, which is just balance sheet reduction. They've already sold over $250 billion in assets, and, the QT is supposed to ramp up in October. So we'll see if that affects things. The dollar right now is still in a very strong rally. So Dave, I know we both follow Sir John Templeton. We're big students of his work. What do you think would be his reaction now to what the central banks have done? Because he's a big time contrarian. Do you think he would be short things yet, or do you think that he would be like in cash like a lot of value investors and waiting for like, something to crack first?
Probably the combination. Shorting, you probably wait for it to crack. Actually, one of Templeton's the most famous trades, people don't realize, was actually a short trade. People see him as a value investor, and he was a value investor. Mostly he bought cheap assets and then sold them after they went higher. But Templeton, what he did in 2000 was he would look at the lockup periods at internet companies. He knew most of these companies are going to zero, and he would look at like when the insiders could sell. So what he would do is short the stock 2 or 3 weeks before an insider could sell. And then he would know that everyone's going to dump when that free up period comes, because even if the stock is down 80% from its highs, the insiders were up, 20 or 30 times in their money, right? So, yeah, and then he would short them, and then there would be a big tank when all that stock hit the market, and then he could cover or just wait until the company's going to go to zero. But he would wait for that. So I think right now Templeton would probably be mostly like have big cash positions, because if you look at the Buffett indicator, the market cap to GDP, price to sales, the 10-year Case-Shiller index, the 10-year, the Shiller PDE, everything is overvalued on this market. So he'd probably be quietly, waiting in cash and maybe shorting select sectors of the market and waiting for things to turn down. I think with shorting, and I've had mixed results shorting in 2015, 2016. I did pretty well with it. Obviously, last year was not a good year to be short. I tried to ignore the big names. I have a small short position on Tesla, but that stock is so crazy and the premiums and the puts are so high. I try to stray away from that. I look for companies that are doing financial engineering. The premiums on the stocks aren't too high if you're buying puts, and stuff like that. That maybe you have a chance on the short side. And what you got to really look at the short side, if you're going to put your Jim Chanos hat on or something like that, is you got to look for something that's a fundamentally flawed business that may decline even the stock market goes up. Like there was a stock called Iomega in the late 90s. And they made this is like when the computer boom, PC boom was happening. They made external drives for CD-ROMs. So this is when people were switching from floppy disks to CD-ROMs. And so if you had a computer that had a floppy disk, well, you buy this Iomega drive, you plug it in your computer, and all of a sudden you work a CD-ROM as well, and without having to buy a whole new computer. So it was a huge boom. This became a bubble stock, and went to hundreds of dollars and ended up collapsing afterwards. But that collapsed while the market boomed in the late 90s. I think it peaked in 97. So that's what you have to look for. You have to look for stuff that maybe can fall even if the stock market, is not rising. There's a guy named we were talking about him right before our podcast named Mark Commodities. He kind of does that. He found Home Capital Group, which is kind of Commodities. Yeah, he found Home Capital Group, which is this kind of very aggressive lender in Canada. He recently had a healthcare stock he was shorting, that MDXG. That's
frauds. Yeah, he finds accounting frauds, like gross, egregious frauds. Yeah.
Yeah, that's really difficult to do, and it's got to be your whole life you're doing that. And unfortunately, I look for longs too, so it's tough for me to just do that sort of thing. But I think you have to find businesses that are fundamentally fraud or frauds like that, and look to short them. So, and then the thing is, if you do get a downturn in the market, those kind of businesses are probably going to fall more. If the market goes down 30%, those things are probably going to go down 90%.
And the stupid disclaimer, this is not financial advice. We're just giving our opinion. Do your own due diligence. Speak to your financial advisor to weigh your risks. But, I think there's a lot of interesting insights you gave there. One of them is the obsolete technology. So some of the best shorts do look for obsolete technologies. You mentioned one of those. The GoPro camera one, that stock was going crazy a couple years ago, and they didn't have any patents or IP, and the stock was going crazy, and then it eventually collapsed at some point. So that was like a fad stock or an obsolete technology because they didn't have any kind of mode or patent protection. But at this dollar index price, Dave, you've had success in the past. I remember interviewing you in the past, and you were in there with blood on the streets buying Greek stocks. Are you looking to do something similar in Turkey and Argentina? Are there actually good businesses that have good balance sheets and well run? And has the stock markets there collapsed because of the stuff that's going on with their government debt and the dollar?
Well, the stock market's always interesting in a hyperinflationary decline, because what happens is in the domestic currency, the stock market might be going crazy. Germany in the 20s, this happened. But in like a U.S. dollars or euros or whatever, in a foreign currency, gold, whatever it is, it's collapsing because the value of the currency is declining. So yes, there are. There's a couple companies in Argentina that actually trade on the NYSE, and same with Turkey. I love in these crises telecoms. Here's why I love telecoms. Number one, telecoms have a lot of debt because, they have to build up the infrastructure, and they usually have to, issue debt to build up that infrastructure. So people might say, like a company with a lot of debt, but the great thing is about that debt, that makes the balance sheet leverage. So it means that when the collapse comes, these stocks can go down 90, 99%, and then you can buy them at the bottom. And most countries, telecoms, tend to be monopolies, right? Like the United States is a huge country. It's 300 million people, largest economy in the world. That's why you guys, and you still only have like, what, 6 major telecom companies? Yeah.
It used to be one and it got split up, yeah.
Yeah, exactly, right? So, like, I live in the Bahamas, we have 2 here, right? And actually one is just kind of an offshoot of the cable company, right? So, most of these countries, even, and then you got like, in Canada, only got like 2 or 3 major providers. So, telecom companies, they have that business. You get whatever, you're getting fees from data, internet, etc. So you've got this like stable business. It's kind of too big to fail because let's face it, if they go under, the government is giving them a cash injection, right? So if you go look at TKC, which is Turkcell, or TIO, which is Argentina Telecom, both of those have been hit recently due to the currency crisis. If that continues, and what I really love about TKC, they issued $1 billion in US dollar bonds in the last 3 years. Now, here's why I like this. They didn't issue a 1 or 2 year bond. They issued a 10-year bond. So they have plenty of time to pay it back. Like I said, stable business, biggest telecom and cell phone company in Turkey. So I've looked at all the past scenarios of these stocks. For whatever reason, let's try to forget why. HL Toy, that was the one in Greece. It went to $1. TIO, that's the one I just mentioned, the Argentina Telecom. It went to $1 back in 2001. These things tend to go to about $1 or so. They collapsed 95% during the currency crisis. Well, TKC, which was $20 a few years ago, is now about $4. So if that goes to $1, say this fall or next year sometime, I think that is like a screaming buy, and you got to look at that. Like, here's a great thing about these trades too. Telecoms also pay dividends, right? Because they're income stream companies. So when everything stabilizes and rebounds, not only will you own the stock at $1 and it might go to $5 or $10 or $20, you're probably going to be getting 50 cents, $1, $2 a share in dividends. So you're going to be getting almost 100% on your money just on the dividend. So yeah. I have to say that this is like the Templeton trade. He did this in '97. He bought South Korea. He bought all these emerging markets that were collapsing. So this is what you want to wait for. And I think as the epicenter is kind of Turkey and Argentina, and you do have ETFs, like I would love to buy Venezuela right now, but because that idiot Chavez nationalized everything, you can't, right? So like that's what you want to do. You want to find these countries. And look at Venezuela's, Argentina's a very simple story. They default on debt every 10 years. You have a collapse every 10 years, and then they rebound again, and then they collapse again. So, but during those collapses, it's a great buying opportunity.
And what about Brazil? Are you looking there? Because Brazil has been having some problems as well.
I think Brazil is a little earlier in the game. Brazil's got some problems where they have capital flight going on, but I don't mean like foreign investor money. I mean like rich and intelligent people are leaving the country because of the problems with crime, etc. So I think Brazil is a little earlier on, but again, when you have these things that are contagions, probably Brazil will catch that contagions in terms of the actual financial markets. And actually, probably the company you want to buy there. And look, this is why you can't be too stringent. I talked about these things going to $1 a share. In 2016, I was looking at Petrobras, which is the big Brazilian oil and gas company, and I was like, I wanted to go to $1 a share. It went to like I think $2.50 a share, and then the stock went to 15 earlier this year. So I think what you got to do with these things is that when you see an opportunity, start averaging down. Buy 10% of your position. I don't know. You buy or 8% of your position every month.
So don't be strict to a certain number then. Just say, you know what, I have a position. I'm not buying all my position at once. If it goes a little bit lower, I'll add more, and I'm comfortable with this. I'm not risking all my money. I know, that things could go bad with this company, but if I'm right about this trade and it goes the way that I think it can, I can make, multiples of my money.
Yeah, exactly. So I would look at And like, look, I don't want to get like my newsletters where I'll get more into details and tell subscribers like if I have a smaller cap play. But I think for like if you're just listening to this podcast, you want to take a small position. You want the large cap companies. You want those telecoms I just mentioned. You want Petrobras. Like that's what you want, right? So that's kind of what I would look at here. Like, but I still think it's too early. And here's the last note about the macro kind of like markets. This is what's kind of interesting about the current Fed tightening cycle is for whatever reason, this whole tightening cycle, they have foregone tightening in September. They basically always tighten in June, then wait in December. In 29 and 87, they tightened in September, and that caused like that kind of like surprise tightening, or that tightening caused this kind of swoon in that September-October period. So they're going to tighten in September this year for the first time, the whole tightening cycle. So let's just see what happens to the financial markets. And look, if you want to buy something, you know what? It's the end of August. Why not wait? Is in 2 months, is stuff going to be that much higher? Why not wait to the end of October and then see what happens, and maybe you can get in at a better level?
Yeah, I would wait until this QT ramps up and the professionals, the human beings with lots of capital are back into the markets after Labor Day and see what they think. Because, you know, they might want to just say, you know what, the budget deficits are blowing out. The dollar rally is going to cause it. I've analogized the dollar rally to like a global wrecking ball for a lot of the economy. And then, you know, the QT ramping up, that could cause problems too, combined with the budget deficits. But for listeners out there who aren't familiar with John Templeton, you know, I think he is one of the smartest investors ever. He was a very poor Tennessee farm boy who worked his butt off and learned and became rich through hard work and, you know, going against the crowd. Some of his most famous quotes are some of my favorites. His quotes are, I'll just read them really quick, Dave. I know you know them. If you want to have a better performance than the crowd, you must do things differently from the crowd. That's 1. Invest at the point of maximum pessimism. That's 2. The 4 most dangerous words in investing. This one is very famous. Everyone quotes it. I don't know if people give John Templeton credit. This time it's different. He came up with that. If we become increasingly humble about how little we know, we may be more eager to search. And my favorite one is, bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. And I think that's probably, that last quote, the best explanation of markets with psychology and fundamentals and technicals that there is.
And actually, he did an interview with a friend of mine right before he died in like 2006, 2007, died in 2008. And what he kind of said was, he didn't know if the markets would ever efficiently work again. Actually, where I met this individual, the guy who interviewed him, this guy named Chris Ruddy, runs Newsmax, which is kind of a conservative-based website. I met him at John Templeton's memorial. So it's kind of interesting that even Templeton started seeing like the problems with cheap money and how inefficient it was making markets, etc. And this was a guy who's basically optimistic. You know, he bought Japan. His biggest trade was he bought Japan in the 60s. And you know, Japan, well, the U.S. went through stagflation in the 70s. Japan absolutely boomed throughout the 70s and then, of course, the 80s, right? So that was like, yeah, that was his first like huge trade that really kind of brought him to the forefront.
He also went long U.S. stocks during World War II, right? So he bought on margin. He bought some of the highest quality U.S. stocks, and then after the war, he profited handsomely off those too.
Yeah, what he did was he bought 100 stocks under $1. And let's say we get this deflationary trade. This kind of segues into something else I quickly want to talk about before we finish here. Let's say we get this kind of deflationary trade into, I don't know, this year or next year, whatever it is, right? And say gold has one more leg down because there's like this final like mass liquidation, and then the Fed, you know, reverses course. That will probably be bearish for the dollar, bullish for gold, etc. Right? So, but let's say there's one more leg down. Is that you'll probably get all these junior mining companies that are really cheap. Well, what Templeton did in the late 30s, his idea was, you know, he could see what was going on in Europe, and probably a world war was going to start. I think actually he did it in 39, so the war had already basically started, and that even though the U.S. wasn't involved in the war yet officially, they were going to supply the Allies. So this would get the railroads moving, the economy moving again after the Great Depression. He bought 100 stocks under $1 a share, And on average, they went up tenfold into the end of the war, like you're talking. A couple of them went up 60 or even 100-fold, and he actually sold out a little early, which tells you it's okay to sell out a little early. But that was, and by the way, he borrowed the 10,000, which in today's money would be like well over 100,000, and then put that money into that trade and made 10 times on his money. And that was his first real, kind of maximum pessimism trade that, the goods and services weren't flowing. A lot of those, by the way, a lot of those companies he bought were railroads, right? So, the economy was bad, but he saw this kind of catalyst. And by the way, that's an interesting point of maximum pessimism. I should note, is an interesting point is you have to see a catalyst for a reason something might turn around. Because otherwise, a company can just go bankrupt and go to zero. But I'll give you one quick example of a company I recommended. I sold it too early as well. But it's called Glue. It's a mobile gaming company, and they have this big product stream coming down. They had a game with Taylor Swift, the famous pop star, and so you can see the stock was depressed. It was $2. It was north of 10 at some point. But you could see these products were coming in that would be a catalyst. Now the stock is $7. So at $2, if you go back 2 years or 3 years ago when it was $2, every article in the stock was negative. Oh, they have no growth, they have no products, they have no nothing. But you can see down the pipeline they have this coming in. So that's another aspect of the maximum pessimism. Obviously, with a telecom or Petrobras, you got a big company with stable business, oil and gas, telecom, etc. You don't really need a catalyst. But if you're going to do a small cap company, you have to have some catalyst. And when he bought all these bankrupt railroads, he saw the catalyst, and the catalyst was goods and services are going to move again because we got to ship steel, we got to ship armaments to basically supply the Allies during World War II. So that's the thing that's going to happen. So right now, I know because some people consider me a gold bug. Probably the precious metals market that's the market we're seeing it. So hopefully, if we do get one more leg lower. And just so you know, I hedged my positions. I bought a bear ETF on precious metal stocks just in case we get this leg lower into the fall. If that happens, say gold goes to 1,100, 1,050, 1,000, whatever it is, then you could really back up the truck and really start getting in these things. Because at some point, the Fed will reverse course with the huge deficits they're running. It's going to be bearish for the dollar, and you will see gold explode. It's just you just don't know how long this is going to go on for until that happens.
And some of the higher cost, to add to your points there, Dave, some of the higher cost gold miners, they've already sold the assets, their non-core assets that were not generating them cash flow. They've been selling them off during the 7-year bear market, and they've been cutting costs to the bone for the last 7 years too. So there's not really that much more that they can sell or cut costs to. So I think, some of these higher cost gold or silver miners could go bankrupt if we do have that leg down. And, that supply coming offline, that would be, from a contrarian standpoint, that would actually be bullish.
Totally. And if you go look at a lot of these companies too, they're not going to expand production. Like Barrick, for example, is paying down their debt, which I think is great, by the way. They took on too much debt, so pay it down now. And by the way, that's kind of a microcosm of what's going to happen in the stock market. All these companies like McDonald's or 3M that blew up their balance sheets to buy back stock and essentially make the management a bunch of money during the boom. And 5 years when their stock prices are down 3/4, they're all going to be paying down debt because they have too much debt. So that's essentially happened in the precious metals arena. It's going to happen in the major stock market at some point. I just don't know when. And it's kind of a microcosm of what's going to happen. But you're right. And there's other factors too. What's going on in South Africa right now. If they nationalize the farms. What are they going to do? They nationalize gold mines next? You don't know. And of course, that would mean the largest producer of gold in the world, their production would probably crash. So there's all kinds of things that can happen as well on the production side. And by the way, in the late 90s when I started, that's essentially what happened. What you're talking about was that 250, 300, no one could make any money. So production just stopped.
I would add, though, with South Africa, they're no longer the world's top gold miner. It's now China. But China actually, the only reason China does this is because China's actually subsidizing the gold, and the Chinese government's buying all the gold, and they're actually losing money on all their gold production. So China's pulled decades worth of gold mining production forward because their total reserves aren't very high, and Chinese government's actually subsidizing all their gold mining production, and they're producing it at a loss because China does not want to go in the open market and buy. They are buying a lot of gold, but they don't want to go in the open market and buy so much gold that it would drastically move the gold price higher.
Well, they rather lose money mining and just put the gold in the vault than pay for it, which makes sense in a way if you can do it, right? Like it's kind of
when you have a trade surplus and you have to put men to work. I guess that's one of the things that you can do. You can waste some money like that.
And by the way, that's the last thing I'll note on that emerging market crisis is you look at all those countries, especially Turkey. They have huge current account deficits that's starting to be punished in the market, and that's similar to 1997 when all the Asian countries like Thailand and etc. went into a big crisis. And see, this is where this is the last thing I'll get on end off on. What will happen if, say, this fall there's some kind of big decline in Turkey or Argentina and the spreads? Is just a correction like 97, 98? The Federal Reserve comes in, cuts interest rates, blah, blah, blah. We have another year or two left in this bull market. Or is this so big that the central banks can't save it, vis-a-vis subprime? And do we get some kind of a larger downturn in the markets?
We'll have to see. But one of the things besides maximum pessimism where Sir John Templeton was looking at stock valuations and the stock price getting cut, he also was able to successfully make projections for a company for their 5-year growth plans. So he was able not only to see stocks that crashed and figure out ones that would survive, he also was able to successfully project 5-year growth plans for those companies better than pretty much any other investor. And I don't think he did a lot of the crazy, financial spreadsheets and those formulas and stuff. I don't think he did that. It was more of an art than a science necessarily, and he was very successful at doing that as well.
Yeah, well, that's what I talked about having a catalyst. And by the way, another thing that Templeton would do is that Mark Holowesko, who kind of took over for him, and he's based in Nassau, he's a Bahamian. He said that Templeton would do something very simple too. That the big investment service back there, it was something called Value Line. And Value Line used to rate these stocks from 1 star to 5 stars, like. A lot of the big retail investors used to subscribe to the service. This is pre-internet, so I used to have one of these things. It was this big thing, and it was like
a notebook, right?
Notebook, and it was mailed to you, and you would take out, the company's last report and put them in. So Templeton's biggest thing was, well, if you see like a 4-star, or 5-star rated Value Line stock, just or your 4-star stock that's like say it goes from 3 to 4, it's going to go to 5. Buy it now, because when it goes to 5, all the retail investors are going to buy it. The stock's going to go up. He would just do stuff like that, which is like almost like common sense, rather than anything else. So he had all these interesting techniques and way of looking at things that that were simplistic, but also really intelligent at kind of the same time, right? So. We probably could use more of that now. And just to end off here. The real difficult part of the markets in the last 5 years is that you have so much central bank intervention. You're not seeing price discovery, as they call it. You're not seeing real value, and that's what makes it's like David Einhorn's in a rut right now. That's the real problem. Is and for example, I found it I talked about glue, right? I bought some Bombardier a few years ago too because it was cheap and they had this new jet coming out. So like you can find it in little pockets. We talked about Greece in 2012, but it's very difficult because the mass markets have been so overvalued. If you're a rational person, you won't participate in this. But of course, then you're criticized for missing out on the gains at the same time.
Exactly. And so if you're a financial professional and you've read all these books and you're doing your due diligence and you're trying to find mispricings in the market, but someone who doesn't know anything about investing just keeps putting money into their retirement account and they're outperforming you, of course money is going to be if you're managing money, of course people are going to be pulling their money out. Because anyone who bought an index fund for the last 10 years has outperformed pretty much David Einhorn and Hugh Hendry and Kyle Bass and a lot of these other guys. But the point that we're trying to make, Dave, is that this is not sustainable. This is not normal.
No, and actually you can kind of see we've gotten this extreme where like a lot of these, John Burbank, who was one of the guys who predicted the subprime crisis, and he's the guy who kind of wears one of those vests, right? That's kind of his, you might know him. He's kind of big, gruff guy with a beard, right? And but anyhow, he lives in San Francisco. And anyhow, Burbank had to shut down all his funds, because he was looking for some kind of big drop in the markets. It didn't happen. He underperformed, et cetera, et cetera. And actually one of the college investment funds that had money with him said something to him, like in a letter that said something to the extent that, writing put options or call options or whatever he was doing cannot beat, the return on the S&P 500. So, by the way, that's what's really scary about what's going on, is that these endowment funds, which would invest with all these like hedge fund managers, like Bass, like Burbank, like Einhorn, etc. What's happened with them is they pulled money out and it just indexed. So when everyone's indexed, it's like an elephant going through a peephole. So they're all in the same trade. They're all long the S&P or long markets. And when it blows up, they're all going to be getting out at the same time, too. And by the way, this is the thing that's kind of the paradox right now. You would think, the market's crashing, horrible for hedge funds. That is going to be the best thing for active management, because all of a sudden it's going to be like, you need to hedge. You need to buy puts. You need to short. So that's going to really change the whole industry again. Yeah.
Exactly. And the volatility will be what active managers and hedge funds will make their profits on, and index funds and retail will get killed on, along with the pension funds. And the pension funds got destroyed in 2008 because they were invested in a lot of the mortgage-backed security. And the pension funds are underfunded, especially in those large Democrat states like New York, New Jersey, California, and Michigan, and Illinois. So, those are problems too. Even if they were making 5% annual compounded returns, is still not enough, because I think they need 8% annual compounded returns, and they're nowhere near that, a lot of these pension funds. So that's another problem. Before we wrap up, Dave, you brought up, you think the next major scandal is this financial engineering, and also, how these, even if a company is using artificially cheap debt to buy back stock, how a lot of these insiders at large corporations are dumping their shares, and the share price isn't crashing.
Well, here's two things on that. This last corporate tax cut really helped the financial engineering, right? Because, look, I'm a libertarian, so I'm totally for more tax cuts, right? But the problem is you have this kind of oligarchy, these people running these corporations. It's all about the management. It's not about shareholder rights. So what they're doing is they're taking that money, let's say you go from 35 to 20%, that 15%. So let's say you make $100 million a year. Right, you're taxed at 35. Well, now you're only taxed at 20. You take that 15 million and you're buying back stock with it, right? So that has basically flushed all this market money into the market. And here's the scandal about it. Number one, a lot of these companies have unfunded liabilities. You talked about the states. Well, like big cap companies like Boeing have unfunded liabilities on their pensions as well. So instead of shoring up their pension plans, they're pumping money to buy back their stock so the management can cash out, right? So that's number one. And number two, it's really simple, that these companies will buy back stock. And actually, the new head of the SEC actually ranted about this in a recent speech, and he was totally right, in my opinion, that these guys would buy back stock, and at the same time they're selling into the buyback. So like Tim Cook of Apple buy back a bunch of stock, and then he'll sell a bunch himself. Well, it's like, how can you use shareholder money to buy back stock when at the same time you're cashing out? It's a total conflict of interest.
It's very unethical. Yeah, it's
very unethical, and it's like like a newsletter writer will get yelled at or whatever, because it's a pump and dump. If he writes up the stock and he's selling into it, which is totally unethical as well. But it's like that's essentially what these corporate CEOs are doing with stock buybacks. And by the way,
if the guy at the SEC is ranting about this, why isn't he fining or charging the people? So
I think it's just lobbyists, and it's difficult to do that. I have a role, like a self-imposed role. If I write up a stock that for about roughly 10 business days, that's 2 weeks, I've recommended stock, I won't sell any, because that way if my recommendation has any influence on the stock, by about 2 weeks, that should be done with, and then I can do whatever I want. But for that 2 week period, I'm just not gonna sell it, and that's it, right? So I think that's the problem here, is that you have these blackout periods. But when the blackout periods aren't on, these guys can buy back as much stock as they want and then sell into it, right? And we're not talking about someone owning $10,000 of a small cap stock. We're talking about somebody owning millions and millions, or hundreds of millions, or billions of dollars of stock in a large cap company. So I think when this all blows up, you're going to look at a stock like 3M, and there's many others. I don't want to just point out 3M, but you go at these companies and say, oh my God, these guys were buying back hundreds of millions, if not billions of dollars worth of stock. Now that stock has collapsed by 80%. It's not, the buyback, they could have bought 4 times as much if they had waited until after the stock collapsed. And these guys were cashing out at the top. And I think it's just like you're going to see congressional hearings and these guys grilled, and it's going to be this huge thing, and you're going to see that totally reformed. And this might be the end of the stock buyback after this kind of bubble. And by the way, so this leads me to my other trade. So on top, like, how are these companies doing this? They're taking advantage of cheap money, borrowing to buy back stock. So I was like, well, my opinion is I look at the balance sheets of these companies, and I don't think they're AAA or A rated. I think they're basically junk because of the amount of debt they've accumulated. McDonald's has done this. 3M has done it. Many other companies. IBM is probably actually the most notorious company that's done it. So how do I make money out of this? So if you go look at the LQD, so this is a trade I'll give to your listeners. The LQD is the investment grade rated corporate bond ETF. Very stable. Usually does not have big moves to the upside or downside. So there's no volatility in the options. You buy the 2020 options, you got an implied volatility of about 4%. If there's some kind of bust between now and the end of 2019, and I'm saying like the implied volatility is like 4%. So if there's a 30-40% move to the downside, you're going to make huge money on the put options on these things, right? So shorting the LQD or buying put options in LQD, it's like subprime. It's like, in my opinion, and this is just my opinion, those investment grade rated corporate bonds are not investment grade. They are junk. So when the market kind of has to, what George Soros calls reflexivity, when the market has to kind of reflex to that and realize that in some kind of crisis, then you're going to see the LQD, which right now trades about 115, it might have to trade at 50 to reflect that. And then you're going to see the huge gains in that trade. Now, and the best thing is you don't have a lot of premium in the trade. You only got a 4% implied volatility. So you can buy something that's potentially mispriced with no volatility that could collapse. Like, that's the perfect short.
It sounds very interesting, Dave. Well, I want to thank you again for your time today, Dave. You are a wealth of information, and maybe I'll have to come visit you sometime in the Bahamas.
Yeah, man, it's better weather than Washington, D.C., and you get away from all those bureaucrats and leeches up there.
Yes, there are a lot of parasites up here. They're like Wesley Mouch from the Atlas Shrugged book. So if our listeners want to follow more of your work, how do they do so?
Go to addictedtoprofits.net. I'm kind of restructuring the website right now and a newsletter, but just go there, sign up for my free list. Once Labor Day ends, I'm probably going to be much, much more active. Long story short, my dad had a knee replacement. I was helping out all summer, so I didn't do as many posts as usual the last month or two. But once Labor Day ends, we're going to be like rocking and rolling again. So go to addictedtoprofits.net. Sign up for my free letter, and then you'll get emails and how to subscribe, information more if you like these kind of trade ideas I have. And I do a lot in private placements too, and if you're interested in that sort of thing as well.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. if YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.